Welcome back. The title of today's presentation is ETFs Under Pressure, Protecting Your Investments with Put Options. I want you to stay tuned for a few tips. The first tip I'm going to give you is how to think about protecting a portfolio. Number two, I want you to think about how to protect the portfolio in an elegant and efficient way. Number three, I'm going to show you tools that you can use to do this. Number four, I'm going to show you the payout diagram. So first, protecting your portfolio. Right now, we're sitting with the market near an all-time high. We know that, right? And I'm getting a lot of calls from investors asking me, how do I monetize this or realize my great result in owning the market? People have highly appreciated 401ks, IRAs, etc. And what they're thinking is, should they sell? Now, this time of the year, it being October, a lot of people start to consider the tax implications of selling. I'm not a tax advisor, so talk to your accountant or your tax advisor about this. But the reality is we're in the fourth quarter. We're at the end of the month of the first month of the fourth quarter, right, October, and people have had nice gains generally in the stock market. So people are thinking about locking in those gains. Offsetting that, of course, with the market at an all-time high is realizing capital gains and thus having to pay the taxes on that. It's a consideration. Obviously, it's a consideration that often makes people procrastinate and potentially lose out if the market were to pull back. But what we're here to talk about is protecting the portfolio. So again, as we've talked about in the past, a hypothetical account size of $100,000, could you protect this portfolio with puts? The answer is yes, of course, if you're qualified to own options. The normal caveats apply. But surprisingly, a lot of people I talk to that have accounts that are 100, 500, even $1 million, are not well versed in their ability to or the simplicity of owning puts. Now, options carry with them the risk of losing all of your premium. I liken this to insurance. Right, you're buying an insurance policy on your life, on your home, and on your car, not necessarily hoping to die or for your house to burn down or for your car to crash, but very realistically protecting against the inevitability of our demise. We're all going to die, and you buy life insurance to protect your family. Number two. Not necessarily are we ever going to face a house burning down or suffering from a hurricane, but I personally have had a hurricane impact my home. Maybe you have too. So homeowners insurance is important, and the high probability of getting into a car accident, even if it's not your own, is something which causes them out there to mandate in most regions, most states, I think, mandate that you have car insurance, right? So all of these insurance policies exist. In the stock market, they developed standardized options 50 years ago, put options a little bit less than 50 years ago. But anyway, the ability to hedge a portfolio. Again, it's not exotic. It's the same thing, a standard put, as buying insurance in any of those situations. So to demystify that, I want to go a little further to, and as I promised you, the free source of financial information, Yahoo Finance, right? We've talked about that before. And today we're going to talk about a ETF, the Semiconductor ETF, the SMH. I'm picking on that for now only because year to date, it's up over 42.7%, right? It's a fairly diverse group of securities within the semiconductor index, right? This is an index constructed of semiconductor companies One of the best performers on the stock exchange this year has been Nvidia, right? It's more news coming up on that one. So if you have a highly appreciated portfolio and you're thinking that things like semiconductors are overextended, it's worth looking at something that's up 42.73%. In the other three examples I gave you, life insurance, car insurance, and homeowners insurance, you're really limited, and it's a moral reason, a legal reason. You can't bet on somebody else's demise. You really shouldn't bet on somebody else's house burning down, and you don't, have an instrument for betting on other people's car crashes, right? I mean, these are, these are, think it through, but you can't buy insurance on outcomes that aren't related to you. In the stock market, you can. So for somebody who has a conservative, let's say a conservative feeling portfolio, they have $100,000 in the market, they're concerned about the fast rise in these semiconductor companies, this is something to explore, right? Up 42% in the past year to date and up over 300% over the past 5 years. So it's fertile ground for looking for protection. I would liken it to buying puts on the semiconductor index would be like buying insurance on taking out an insurance policy on somebody who's a reckless driver of a Ferrari, right? You can potentially get paid if they crash that Ferrari, and again, you don't have to buy the Ferrari. So let's see what the options cost, right? That was what we've looked at before. The semiconductor index, SMH, or the SMUSH as people call it. You could buy options. Yes, they have weekly options. And let's just say, as we did in the last episode, talk about the November 8th options. November 8th, right, gives us through the election. Some people believe that the election has a big impact, or can have a big impact on the stock market, the volatility of the stock market. I'm not so sure, but and this isn't about politics. This is about making money. So again, the semiconductor index is 249 spot 49, $250, let's say. So we're going to look at the puts, in the money puts, 250 are trading at $8. And this gives us until, again, November 8th, right? So let's enter into the spreadsheet I made. We're going to put in SMH. Current stock price is $250. The put price, as we mentioned, is $8. Sorry, typo. Put strike price is also at the money, $250. So it's going to cost us for those 2 weeks about 3% to protect this portfolio. On a $100,000 account, we can protect ourselves for the next couple of weeks. It's going to be 3.2% of that portfolio to protect against a decline in semiconductors. Now, as we pointed out, semiconductors have been pretty volatile. We're using this as an indirect hedge, right? Unless you're long the SMH, you would argue, hey, Brian, this is not a perfect hedge. I agree, right? Unless you have a basket of semiconductor companies, what you're really doing is betting on an overextended element of the market, using that as insurance on your general portfolio. Think about it this way. You own property in New York. You don't have the ability to buy insurance on that residential property for whatever reason. So what you do is you take out a bet on residential property in Florida, right? A hurricane comes, you get paid on that insurance. That's kind of what this is. Again, a more direct hedge to a generally diversified portfolio would be to buy S&P 500 puts. Let's look at this for a second, though. S&P 500 being a broad index. This is the payout diagram. So obviously, if the market goes down, right, semiconductor market goes down, you're going to make money, and your payoff could be all the way up here. The put payoff diagram, right? So here's the account value, right? As you would expect, at $250, which is break even, you will have spent 3.2 $3,200 to protect this portfolio for the next couple of weeks through the election. But let's say because of the election, there's a 10% decline in the broad market, and semiconductors go down just as much, which one could argue they've been more volatile than the general market. They might go down more, but in that case, if your account were to go down 10%, on $100,000, you'd go to $90,000, right? But at expiration, the puts would have some pickup, and you would be protected. You'd be making $6,800 on your puts. Your account would be worth $96,800, right? Now, the chances of the market crashing 10% in the next 2 weeks is minimal, right? The chance of 10% move, but it's non-zero, and there is an election coming. So the perfect world is the market doesn't go down as much, but semiconductors go down very much. But this is what it costs to do it over a couple of weeks. Let's see what it costs to go out through December, right? And we want to buy at the money puts just for an example. This costs us $13.70, right? So we get past the election. We go all the way out to nearly Christmas, right? December 20th, right? And the cost of those puts, $13.70. Okay. So we go back here. Stock symbol hasn't changed. The current stock price hasn't changed. The put price is now 13.70. So it's going to cost us 5.5%, 5.48% to protect us through the rest of the year, $54.80, right? We get to keep the account at $100,000, and we've put on a bet of $5,480 that the market for semis can go down, and potentially more than the market, but at least in concert with the market. So let's say, again, between now and the year and December 20th, the market corrects 10%. Your account would go down to $90,000 if unhedged. This hedge, right? If semis go down 10%, you have a profit of $54.20, right? Net of what you've paid. So it goes to $94,520, right? So that's your account. No matter how much no matter how much the stock market goes down, if semis go down as much, you're going to be hedged. You're going to be producing profits, at least on the puts. And so, if the market were to go down 15.5%, 84,500, your puts would be worth $10,000 plus, right? $10,020 exactly, and you'd still have 94,520. And that's using the semiconductor ETF to imprecisely and non-perfectly, but still protect in the case of a broader market decline in which semiconductors go down. Thanks for joining.